Hey everybody, this is Jeffery Campbell with Friar Financial. I'm here to give you a little overview over our retirement focus framework. So our retirement focus framework is all about putting clients first. We tailor our strategies to each individual's goals. We build a comprehensive plan for retirement and stay by their side with ongoing support the whole time. So the goal is to help them feel more confident about their financial future. And we do that by maximizing income, minimizing risk, and creating a lasting peace of mind. That's our end goal, of course. So when it comes to managing retirement income, income is everything when it comes to retirement, but it's also very fragile. Portfolio losses in retirement can have a disproportionate impact, making downside risk management absolutely critical. And as life expectancy increases, so does the number of years we need our portfolio to return. So the key is just striking a balance, achieving the returns necessary to sustain retirement while minimizing exposure to large drawdowns. And so growing wealth isn't just about chasing performance. It's about protecting what you've already built. So there are three essential pillars, and it starts with managing risk, and then we go into reducing exposure to major market down cycles, maximizing maximizing tax efficiency is the last one. So together, these strategies create a long foundation for sustainable long-term growth. So that's what we're looking to do there. And so managing risk doesn't mean just settling for less. It means earning more over time. In fact, our approach is delivered a 2% greater annual net return. That's a 2% greater annual net return over passive portfolios with similar or even greater downside risk. So over 25 years, that difference compounds dramatically. And whether you're investing in a lump sum or contributing regularly, the impact of compounding at higher net returns can be so transformative to the success of your retirement income plan. So we can take a look at that. And so this graph, it shows the impact of the difference in net returns of 2%, with one portfolio having an ending balance of $429,000 after 25 years, and the other with increased performance at $685,000. Keep in mind, these are not actual results, but are based upon Monte Carlo simulation data. This is similar to how we run 1,000 Monte Carlo simulation to predict the success of a client's financial plan. So same concept. And so history has shown us over the years that avoiding large losses is one of the most powerful ways to compound wealth. Events like COVID, like the COVID downturn in 2022 and the trade wars that we're in right now remind us how quickly the market can shift. And as Warren Buffett wisely said, the best way to compound money is to avoid large losses. I'm going to say that one more time. The best way to compound money is to avoid the large losses. So our strategies are built to sidestep the worst of these cycles. So tax efficiency is also very oftenly overlooked, but it's a silent driver of long-term performance. Over the past 4 years, our portfolios have maintained a low average realized gains, helping investors save roughly 1% in taxes during up years. And then, and when that 1% is compounded over time, it becomes a meaningful contributor to your overall wealth. So it's important. And so retirement income isn't a one size fits all thing. We divide income into three bigger categories or buckets. The first one is minimum guaranteed income. This covers your mandatory fixed expenses, all that kind of stuff. Second is your conservative flexible income. This supports the lifestyle you want to maintain. This is your fund money. Oh, and then we go into your third one. Excuse me, I jumped ahead a little bit. Then we go into your third one, which is your desired extra income, and that's where your fund money is for your travels, your hobbies, your experiences. We build portfolios with all that in mind, and we want to align our portfolios with each of those needs and make sure we're hitting each one. So, to make your retirement portfolio last 20 years or more, it must be built with intention. Intention, intention, intention. First, it must be designed to generate a consistent cash flow. Second, it needs multiple powerful income streams, not just one or two. And third, you need access to investment strategies that most individuals simply cannot access or perhaps execute on their own. That's where we come in. And so as you can see from this chart, the portfolios offered by our portfolio manager, Markin, have been able to generate a 90% probability of producing increased income as compared to an all equity or 60-40 portfolio, which is important. So here's another thing. The moderate aggressive portfolio, which is a 50-50 portfolio, 50% equity, 50% bonds, has actually outperformed the aggressive portfolio, the traditional 60-40 portfolio. Reason being, over the last 20, 30 years, they focus on reduction and risk management has resulted in increased returns tenfold. So that risk management is the most important thing that we're trying to drive home. And then, so the most valuable thing that we do for our clients is to optimize their cash flow in retirement, keeping your money coming in. We help offset rising taxes, market volatility, healthcare costs, and inflation, so you can focus on just living a life that you've earned. Our strategies are effective in any market, environment, and we provide access to these investments, insights, and strategies that generate that maximum income in retirement. So to enjoy that work optional lifestyle that we should all look forward to in retirement, we need to focus on growing your wealth by managing risk and avoiding those large market losses, and then realizing that tax efficiency too. So those are the big things. To structure a portfolio to focus on income retirement, the portfolio must have three things. So we're talking about a consistent and reliable cash flow, multiple diverse income streams, and then access to a sophisticated investment techniques focused on risk management. And that's all I have today. We just want to keep it short and sweet and kind of give you what our framework is, and just thank you for watching, of course. And we're just a phone call away, as always, to assist you.